Welcome to this explainer. Today, we're diving into something really fascinating, the rapid, comprehensive transformation of Rwanda's financial landscape. We're unpacking a suite of brand new 2025 and 2026 regulations that are literally rewiring how the country handles everything from AI and crypto to digital banking and mobile money. If you're looking to understand how a modern economy future-proofs its financial sector, well, you're in exactly the right place.
It all really boils down to this fundamental question. How do you regulate the future of finance without stifling innovation? Because it's a tightrope walk, isn't it? Push too hard and you scare away the innovators. Regulate too loosely and you're risking systemic crashes. But that's exactly the challenge the National Bank of Rwanda and the Capital Markets Authority are tackling right now. They're trying to build a system that's rock-solid secure, but still incredibly attractive to frontier tech.
So here's our roadmap for today. We'll start by looking at frontier tech, which covers AI and crypto. Then, we'll move into consumer empowerment, exploring digital services and portability. After that, we'll cover system stability through acquisitions and investments. And finally, we'll wrap up with what this means for stakeholders and how you can track these policies with Nexus.
All right, let's get into part one, frontier tech, AI, and crypto. So jumping into this first pillar, this is where we see that regulatory balancing act at its absolute most intense. We're talking about the explosive growth of artificial intelligence and digital assets. Taking a look at the new AI risk management guidelines, what's genuinely groundbreaking here is the recognition that AI isn't just a standard piece of software. The central bank is saying, hey, financial institutions have to continuously govern these AI models for their entire life cycle. You can't just plug in an algorithm and walk away. These systems have to be constantly monitored for things like model drift, data bias, and operational resilience.
And when it comes to what they call high-risk AI, so anything making autonomous credit decisions or running biometric ID checks, the rules are incredibly strict. You absolutely cannot deploy these systems without an independent second-line challenge. That means the risk team has to test it totally separately from the developers. On top of that, you need explicit board approval, you have to notify the central bank before going live, and most importantly, there has to be effective human review. No machine gets to run completely unchecked when people's financial livelihoods are on the line. We're also seeing a massive pivot when it comes to cryptocurrency. Under the new virtual asset business law, running a crypto business as an unregistered individual is a hard no. But for legal entities, it actually brings crypto completely out of the shadows. If you want to run a crypto exchange, manage digital portfolios, or issue stablecoins, you just need to be formally licensed. And for the innovators out there, they've set up a regulatory sandbox. It's basically a safe, heavily supervised environment where you can test out new crypto concepts before launching them to the wider market.
Honestly, the whole philosophy behind this crypto regulation rests on three main goals. Every single rule in that law serves one of these purposes: stopping illicit funds with strict anti-money laundering controls, ensuring market integrity so things stay fair and transparent, and giving everyday investors rigorous consumer protection against fraud. Ultimately, it's about legitimizing the tech by weeding out the bad actors.
Okay, moving right along to part two, consumer empowerment, digital services, and portability. So while part one was all about high-tech infrastructure, this section, it's really about the everyday person using a smartphone to manage their life. The central bank saw a huge need to set a strict baseline for how financial providers interact with borrowers, especially in this booming, app-based digital loan and savings market. Basically, we are officially waving goodbye to the old way. You know those predatory tactics? Like a loan app scraping your phone book without your consent just to harass your friends if you miss a payment. Yeah, that is explicitly banned now. Using recovery agents without telling the borrower, also banned. The new way is all about total transparency. We're talking clear daily and monthly interest rates, strict consent for any contract changes, and real-time income-to-debt assessments. They're making sure lenders aren't burying people in debt they literally can't afford. Sticking with that theme of consumer empowerment, let's talk about the new guidelines for mobile number portability. Imagine you want to switch your telecom provider because, say, you found a way better deal. But you're terrified you're going to lose access to the digital wallet or mobile money tied to your old phone number. Well, these new rules guarantee that simply won't happen. As a consumer, you now have mandatory post-porting rights. This means your mobile wallet access has to remain instant and totally seamless, regardless of your network. Providers can't force you to cash out your funds just because you're switching telecoms. You're guaranteed the exact same quality of service, and if the technical porting process somehow fails, there are mandatory reversion mechanisms built in so your money is never lost in digital limbo. It really just gives consumers total freedom of choice. Let's transition to part 3, system stability, acquisitions, and investments. Now, empowering consumers and boosting tech is fantastic, right? But none of it really matters if the foundational institutions end up collapsing. The central bank is working incredibly hard behind the scenes to safeguard the overall system from reckless corporate behavior. And that brings us to this highly significant number, 5%. Under the new directive, a deposit-taking microfinance institution, or DTMFI, can't just go out and buy land, buildings, or huge software packages that exceed 5% of their core capital without getting prior approval from the central bank. It's designed to stop them from using depositor funds for risky, massive asset grabs that aren't actually necessary for their core business. Along those same lines, we have this hard cap, 25%. A DTMFI is strictly prohibited from investing more than 25% of its core capital into the equity shares of other companies. And honestly, even just to get to that number, any major investment requires a full 3-year business plan and a cost-benefit analysis submitted straight to the central bank. It is a massive guardrail against overexposure to outside markets. And we're seeing that exact same focus on stability applied to payment service providers. Basically, if 2 major payment platforms want to merge, or one wants to acquire another, they can't just do a backroom deal in secret. They actually have to follow a very clear, highly transparent regulatory process. Step 1, they have to submit a massively detailed business plan proving the merger won't harm the public. Step 2, the central bank rigorously assesses if this new combined entity will be well managed and financially sound. In Step 3, they give a definitive yes or no within 1 month. It's a brilliant way to ensure no single provider monopolizes the market or creates a bloated company that could threaten the whole system if it fails.
Which brings us to part 4, what this means for stakeholders.
So what's the ultimate takeaway from all this? When you look at all 6 of these regulations together, from AI and crypto rules to digital loan transparency and strict acquisition limits, what does it actually mean for everyone involved? I think it's perfectly summarized by a quote directly from the source texts. These policies are all about reinforcing the central bank's commitment to financial inclusion, financial integrity, and the stability of the financial sector. If you're an innovator, the rules of the game are clear. You can build here, but you're going to build safely. If you're a consumer, your data, your dignity, and your deposits are fiercely protected by law. And for institutions, it means operating in a space where reckless behavior is systematically shut down to protect the entire ecosystem.
Finally, part 5, track policies with Nexus.
Listen, if you are a financial professional, a tech developer, or a market analyst, keeping up with these fast-moving regulations is absolutely critical. You really can't afford to fall behind on compliance or miss out on a new sandbox opportunity. To make sure you always have the most accurate, up-to-date info, I highly encourage you to use the Nexus Tech Policy Tracker. You can monitor all these shifts and stay completely ahead of the curve by visiting www.ntpai.nexustechpolicyadvisors.com. It is hands down the smartest way to navigate this modernized regulatory landscape.
So that leaves us with one final, pretty exciting thought. Rwanda has just laid down a highly modernized, tech-forward, and incredibly secure foundation for its financial sector. The guardrails are up, and the innovation sandbox is wide open. So the only question left to ask is, with this foundation now set, what will Rwanda's financial sector build next? Thank you so much for joining me for this explainer. Keep learning, keep innovating, and I'll catch you next time.